For today's video, I want to talk about how to put money into the market. There's been a lot of new viewers on the channel wondering exactly how they should start going about first buying a stock and then putting additional money into the market. So I wanted to do a dedicated video talking about two very good strategies in which I use in putting new money into the market, and those are dollar cost averaging and value cost averaging. I've talked about these on prior videos. I think they're very, very powerful, and I think all new investors should really know what exactly these types of investing strategies are about. So let's take a look at VOO here. This is a very good Vanguard ETF. If you go to the bottom here, you can see this is an index fund. It is an S&P 500 ETF tracking a market cap weighted index of U.S. large and mid-cap stocks selected by the S&P committee. So essentially what is in the portfolio, what is in this ETF, is simply from an algorithm based on an index that, again, is using the S&P 500 market cap weighted index of U.S. large and mid-cap stocks. So there's really no active management. Because of that, the expense ratio, the fees charged to investors to hold this stock are very low, 0.04%. And you can also see in the middle here, this is a very popular fund. The market cap there is $88.85 billion. That is a very, very large market cap for an ETF. This is a very popular ETF for a lot of investors' retirement accounts. And again, it is very popular because it's a quality stock from a quality company, Vanguard. It has a very low expense ratio, 0.04%. So now that you have selected a stock, and again, I'm not a market professional, this is simply the stock that I would choose personally to put in my portfolio. And I do have this stock in a Vanguard account, really my retirement account. And this is what I employ to put money into the market. So you can see over the last 3 months here, the stock has had a period in which it has been tracking up, and also where it has pulled back. So how should you put money into the market? What you want to try to avoid is putting all of your money in when the stock price is very high, only to have it trend down later and losing a lot of money, which may take months to years to recover. On the flip side, you would want to put all of your money in when it dips down like this, but that is very, very difficult to do, and there's been no strategy that you can reliably time this dip here. So because you can't time dips and you don't want to be putting money in one lump sum when the stock is very expensive, and again, you can't predict these points, a very good way of putting money in is what's called dollar cost averaging. So for example, this stock here, let's say every month you want to put in $1,000 in your portfolio. So the first month you put in $1,000 here, second month $1,000, third month $1,000, so on and so forth. So every month your portfolio would be growing by $1,000. $1,000, $2,000, $3,000, $4,000, and you really put in that same amount of money no matter what the price of the stock is. So you put $1,000 here, $1,000 here, $1,000 here, so on and so forth, and you essentially grow your account over time. And that is very good to avoid market timing. If you take a look at the 5-year graph, you'd simply be putting in money on a regular basis over this entire graph here. So you'd be basically balancing out these dips with any rises in the stock price. And again, this is a very good fund. You can see it's up 98.74%, but not all ETFs will do this. Some will have a period of time, maybe 2 or 3 years, in which it is trending down. That's okay. You continue to buy because over the longer term, that period would essentially be stocks that have been on sale. So if we take a look at this graph here, let's say this was a 10-year graph. Over the majority of the stock graph here, we'd be buying when it is trending up, but then when it trends down, you also be putting in money. And again, these dips here will balance out some of these very expensive stock buys, and over time you'll have a very good rate of return, a very safe rate of return, because you're putting your money in regular intervals over a long period of time, 10, 20, 30, 40 years. Another way of doing this is what's called value cost averaging, a little bit more sophisticated. And with value cost averaging, you're trying to meet a certain portfolio value. So unlike dollar cost averaging where you put in $1,000 no matter what the price of the stock is, with value cost averaging, you have a goal every month. So the first month would be $1,000, $2,000, $3,000, so on and so forth. So if the stock is trending up in price, that will help you meet your next goal. So you'll be buying less shares on the next goal. So 1,000, let's say 1,000 is here, 2,000 is here. Because the price of the stock when you buy it at 1,000 is now trended up, you may only need to buy $400 worth of stock here to make your $2,000 goal. So as the price of the stock goes up, with value cost averaging, you buy less amount of shares. On the flip side, if the stocks are going down, so let's say you had $2,000 here let's say the stocks went down by 1,000, so now you have 1,000 here, but your next goal is 3,000. Now you have to buy $2,000 worth of stock, so now you'll be buying more shares when the price of the stock is dipping down here. So it's a little bit more sophisticated way of dollar cost averaging, in which when the stock is trending up, you buy less shares. When the stock is trending down, you buy less shares, just because you have a set goal that you try to meet every month. And let's say the stock did very, very well. So you're putting in, again, $1,000 at every interval for dollar cost averaging. For value cost averaging, your first interval you want to make is $1,000. Your second one is $2,000. But let's say the stock increased from, let's say, $1,000 to $3,000, your total portfolio value. Now you're $1,000 over what you should have in your portfolio. So for this particular month, you'd actually sell off some stock to make that $2,000 portfolio. Again, some investors may just hold on to that with regards to long-term capital gains. But if you do the strategy the way it's supposed to be done, you essentially sell off some stock, again, hoping that it would trend down a bit, and then if you would be able to essentially take those profits and buy the stock back when it dips down. Again, much more sophisticated. For new investors, I think I would go with dollar cost averaging, and then when you become a little bit more familiar with how to buy and sell stocks, start employing value cost averaging. But those are two of the most well-known and best-known over time to grow your money, and the safest as well. So it's safe, it's reliable, and it's very easy to do with a little bit of practice. Even dollar cost and value cost averaging will be very, very simple, and you can really just automate this. You can put in, for dollar cost averaging, just put in 1,000 every month, for example, or whatever it may be. It doesn't have to be $1,000. Maybe it's $10, maybe it's $100, maybe it's $10,000. You simply put it in without even thinking about what the price of the stock is. Doesn't matter if the stock is doing very well or it's crashing. Put in the same amount of money. Value cost averaging does take a little bit more time, but again, you simply have a goal set out and then buy stocks up to that goal. If you're over the goal, you basically sell off. And if you're way under the goal, then you'll buy a lot more shares when it is trending down. So those are the two best ways of putting money into the market for new investors. Again, I'm not a market professional, but I really think these are the way to go in putting money into the market, again, to avoid market timing, buying stocks when they're very, very expensive. So let me know if you guys are also doing the same type of strategy. I do this for the most part on my other accounts. The Robinhood portfolio here is really about a little bit higher risk strategies, day trading, swing trading, doing some dividend capture, swing trading activity as well. Buying some stocks I wouldn't necessarily buy on the other portfolios like Portola, PTLA, very, very risky stocks. But again, as I've said on many of my videos, the higher the risk, the higher the reward. So risk equals reward on the stock market, and dollar cost and value cost averaging are ways of getting rid of risk. So you won't have as big of a return over time, but you'll have a very safe amount of return, which is what you want in your retirement portfolio. So again, not to make the video too long here, let me know what you guys think about dollar cost and value cost averaging. If you're using them, or if you're not using them, why are you not using this type of strategy? So kind of with that, I'll end the video here. Again, if you guys have any video ideas, let me know. I'm always looking for new videos to put out. If you guys have any questions about this video or other videos, again, let me know in the comment threads down below, and I'll do my best to get back to you guys as quickly as I can. So again, not to make the video too long, I guess I'll end it here, and we'll see you guys next time.